financial advisors, planning for life. Wealthway Financial Advisors, planning for life.
And good evening, Hampton Roads. Welcome to another edition of Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm your host, Certified Financial Planner Kevin Zivna, coming to you live like I do every second and fourth Tuesday of the month to dialogue with you, take your calls. If you have a question or comment relating to your own personal financial situation or anything I'm talking about here tonight, jump on the phone lines. Give me a call, 627-7979. All we need is your first name, city you're calling from, and no matter what I'm talking about, if it's important to you, then it's important to me. We'll get you right on air. 627-7979. Wealthway Financial Advisors is the proud sponsor of Dollars and Common Sense. We are an independent registered investment advisor, which means we're legally held to a fiduciary standard to put our clients' interest ahead of our own in any business dealing or recommendation that we make. And that's the way it should be when you work with a financial advisor. As the premier financial planning firm in Hampton Roads, we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. So by design, we can't work with everyone. We work with a relatively small group of high net worth individuals, but that's one of the reasons we feel so strongly about coming here every second and fourth Tuesday at 6 p.m. And that's to reach out and help as many people in the Hampton Roads listening area that we can achieve your measure of financial success, because it is a core belief at Wealthway Advisors that the overwhelming majority of people in this country have the opportunity for financial security if they choose it. And it is a choice because it takes some time, it takes some effort, and it takes some knowledge. We are here to help. You got to take that first step, though. Pick up the phone. Give me a call, 627-7979. Whether you want to talk about anything having to do with the investment markets, the economy, insurance products like life insurance, health insurance, property casualty, taxes, tax planning, tax reduction strategies. We're going to talk about some of that tonight. Retirement planning, retirement plans, 401ks, 403bs, TSPs, IRAs, Roth IRAs, mortgage options, Social Security claiming strategies, or estate planning, wills and trusts. All that and more falls under the umbrella of personal finance. We are here to discuss tonight. 627-7979. All right, yes. Happy tax filing eve day. Well, it is the eve of tax filing deadline. I don't know how happy it is, but we're going to talk about taxes tonight. You're going to find out a little bit too late to do anything about most of your tax situation, except for file on time, of course. But we're going to talk about tax planning versus tax filing and why most people end up doing it backwards. So, every year around this time, millions of Americans are focused intensely on filing their taxes. And then the stress, the deadlines, the paperwork occupy brain space, dominate conversations for weeks on end as people prepare to file their taxes. However, filing taxes and planning your taxes are not the same activity. Filing taxes, that activity we're doing now, looks backward at what already happened during the previous year. Tax planning looks forward and asks how financial decisions today will affect taxes over time. And so we're going to talk a lot about tax planning today because that's what we do at Wealthway. We don't do tax preparation, nor do we want to, but we definitely do tax planning, forward-looking tax strategies that can help our clients lower their tax bill substantially over the rest of their working lives and even their lifetime. So many taxpayers believe the person preparing their return will somehow reduce their taxes during the filing process, right? I got a tax guy. He's really good. My tax lady, boy, man, she gets me a refund every year. But really, by the time a return is filed, most of the decisions that determine the tax outcome have already occurred months earlier. and either your income was earned, the investments were sold or held, retirement contributions were made or not, or skipped, deductions were either captured or missed. Those things have already happened. By and large, most activity is in the books for 2025. So the goal of the show today is to help you understand the difference between reactive tax filing and proactive tax planning. And hopefully by the end of the episode, you should have an understanding how thoughtful decisions throughout the year can reduce tax surprises, lower your stress, and then potentially improve long-term financial outcomes. So it is a truism that taxes, as along with death, are a normal part of life. There's no getting around that. And so from a financial planning standpoint, the goal when it comes to taxes is usually coordination is the word we use, not tax avoidance, although that is prudent at certain times. But you'll hear me say a lot, we don't let the tax tail wag the dog. Most people get hyper-focused on trying to lower their tax bill as low as they possibly can, and for a good reason. Most families' largest expense is their federal and state income taxes. Mortgage comes in usually in third place. So taxes being the largest household expense, the lower you can make them, the more income you can keep. However, I will say that the lawmakers in Washington, D.C. have become very expert at designing a tax code that is known as progressive, which means the more income you make, the more taxes they will take from you. And while there are some ways to lower your tax bill, legal ways, of course, to lower your tax bill and ways to structure your financial affairs that will help reduce your overall tax bill, you shouldn't focus on that at the expense of the growth of your overall net worth, because the growth of your net worth is the ultimate measure of your wealth. And in order to grow your wealth, earn more money, you're going to have to pay some taxes to do that. So that's the price of living in the civilized society, or so I am told. And so that's the way the tax code is structured. So you want to make money, you want to earn money on your investments, you want to grow your income, and it's just going to be a reality of the situation that you're going to pay more taxes as your income grows and potentially as your net worth grows. So that's the bottom line, because growing your net worth grows your wealth. Reducing your taxes is helpful in that regard, but you don't want to do that at the overall expense of limiting your net worth growth. So, as I stated, most tax outcomes are determined during the year, not in April. And you want to think about taxes as part of a broader financial planning decision if you want to be, and here's another term we like to use, tax efficient. We're not able to eliminate taxes very well, or at least not in a healthy manner, but we can be as tax efficient as we can and pay the lowest amount of tax for the financial activity that we generate. So why is tax season so stressful anyway? Well, for most households, tax season feels like an annual surprise. There's sort of this mystery surrounding it. Documents arrive in the mail. Sometimes they come in via email nowadays. Sometimes you just get an email saying, hey, your 1099 is available online. Go get it if you want it. So you got documents coming from all over the place. Numbers usually appear higher than you expected. And so then you start getting angry about the situation, and the entire process feels reactive. But the truth is that most tax outcomes were already determined from January to December in 2025, and those decisions aren't going to change too much up until tax filing time of April 15th. So the the surprise nature of what are my taxes going to be. And then you have the tax preparation software companies, which I do think overall have been a boon to taxpayers. They allow you to do your taxes usually for cheaper than if you had a person do them. And if your tax situation is simple enough, then you probably can do that yourself rather successfully. But those companies like to sort of make a game out of tax preparation and make it seem like Christmas morning when that you're going to get a big surprise refund by using their tax software. Well, maybe you will, maybe you won't. It's not so much the tax software; it's how you arranged your financial affairs for the previous year. So, tax filing again, mainly reactive, not proactive. And April 15th is usually too late to change most outcome. And so people tend to, as the date approaches, if they haven't filed yet, the emotional stress just starts to wear on you. And then taxes are often confusing even for people who are financially savvy. And I know that's true even in my case. When we have to do a deep dive research into the tax code for our clients to research maybe an arcane area of the tax code, I read this somewhere else before, but I use it all the time. The tax code will alternatively make you laugh and cry at the same time as you read tax code. It is mind-numbingly complex. And so I get a visceral, angry reaction when I have to dive into the tax code because it shouldn't have to be this way. The tax code is now like something like 70,000 pages. Just ordinary, average American citizens trying to pay our taxes, a $70,000 book of tax code is not conducive to doing that efficiently or even effectively. It doesn't have to be this way, but that's the way Congress writes the law, and that's the way the IRS writes code in order to reflect the law to help people comply with it. And it all stems from Washington, D.C., and they are the ones who create the tax mess that we have. Regardless of what you think of how much to pay, I'm not even talking about how much and what the tax rates are, the tax brackets. I'm just talking about the complexity of the tax code is inexcusable, in my opinion. And I would love for us to reach the breaking point at some point where Congress, in a bipartisan fashion, would come together and overhaul the entire tax code and allow people to make it much easier and more streamlined and less stressful over this time of year. But of course, that would take political will, leadership, and both those qualities are in short supply in Washington, D.C. Usually most of the time, not just now, but most of the time. That's not politicians' strong suit. Regardless, that's the end of my editorializing. I hope for the rest of the show we try to stay away from that because a lot of other people do it better than we do here. I'll try to stick to some of the more technicalities on how you can lower your overall tax bill by doing forward-looking tax planning, not just tax filing. We're going to talk more about that when we come back from the break. If you want to jump on the phone lines, give me a call, 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, look us up online at wealthwayadvisors.com. All right, tonight we're talking about the difference between tax planning and tax filing. So a few fun facts about tax filing, if there is such a thing. I mentioned that U.S. tax code has now up to 70,000 pages, which does nothing but contribute to taxpayer confusion. So there's that. More than 160 million individual tax returns are filed annually. So 160 million tax returns. IRS filing statistics consistently show that a large share of taxpayers receive refunds each year, and refunds typically reflect withholding patterns rather than actual tax savings. I'll talk more about that as the show goes along, because everyone thinks, hey, I got a refund, great. Well, yeah, I guess it's better than paying sometimes, but usually just meant that you gave Uncle Sam more money than you needed to, and he got an interest-free loan at your expense. So anyway, those are some facts about current tax code. And one of the things that I was talking earlier before the break about the stress around tax filing time, one of the areas where we see people start to get wrapped around the axle is when they sell investments sometime during the year, like mid-year, and then only after the fact realize the capital gains tax impact. Now, we take care of all this for our clients, the buying and selling of investments and recognizing capital gains and determining tax along the way. But when we get a new client on board, what they did the previous year, we had no control over. And oftentimes when they sell investments, most people don't realize that that's a taxable event somehow, some way. Selling most things for a capital gain or loss is a taxable event somehow, some way. So you're either going to have a gain or a loss when you sell an investment, and it's either going to be short-term or long-term. And depending on whether it's gain or loss and short-term or long-term determines your tax rate that you pay. The highest tax rate that you pay when you sell investments is short-term capital gains. Short-term capital gains are taxed at capital gains, another term for profit. So short-term profit, those investments held for less than a year are taxed at ordinary income tax rates. Ordinary income tax rates are the rates you pay on your income that you get from your job. Those are the highest income tax rates. You hold that investment for a year or longer, then sell for a profit, then you get to enjoy lower capital gains tax rates. And those range from 0%, depending on your taxable income, up to 20%. So high income people pay 20%, lower income people pay 0% on their long-term capital gains. Most of us will pay 15% on our long-term capital gains. So you can just see just around the different rates that are involved in determining your tax when it comes to just selling an investment. There's a multitude of different options there. And it's very important that you retain cost bases. I'll also talk about that more as the show goes on. So what does tax filing actually do? The tax filing primarily reports what already happened during the previous year. It calculates the tax owed based on your income, your deductions, credits, any withholding that you had out of your paycheck. And by the time the filing process begins, most of the events that affected taxes have already occurred. So there's a lot of misconceptions that flow from tax filing, such as things we hear. My accountant will reduce my taxes when I file. Well, he or she may or may not. It's not so much that the accountant will do it. It's what you have done or not done throughout the course of the year that determine what your taxes will be. And then I'll find deductions when preparing the return. That's what a lot of the software companies want you to think. Use their software, they'll find you more deductions. Well, they may, then if you did it yourself alone, just with a pencil and paper, I'm sure they would compare to that. But would they outperform, say, a CPA or an experienced tax preparer? That's doubtful. Here's another one. If I owe money, something must have went wrong. Oh, hey, I got to write a big check to the government at the end of the year. Well, maybe that happened. Maybe it was intentional. Sometimes we do that on purpose. And then finally, tax refunds mean I paid less in taxes. Hey, I got a big refund. I stuck it to Uncle Sam. No, not necessarily. Uncle Sam had been borrowing your money for zero interest. You didn't really stick it to him that bad. All right, we got to pause right here for the news at the bottom of the hour. We'll be right back after these messages. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can check us out online at wealthwayadvisors.com. Once there, you can request an information packet to find out what it's like to work with us, or sign up for a free quarterly newsletter at wealthwayadvisors.com. Just go to the Request a Consultation page, put your name and address in the dialog boxes there, select the appropriate drop-down menu, and we'll get that information out to you later on this week. And that's all we will use your name and address for, is just to send you the information that you request. Or if you have some nuanced questions, want to speak to a live human being, we got those too. Give us a call at the office, 757-456-2200. Want to remind everybody, our next live show will be in 2 weeks on Tuesday, April 28th. But if you can't catch us live every second and fourth Tuesday of the month at 6 p.m., get the show as a podcast. Search for Dollars and Common Sense wherever you get your podcast. Download us, take us with you where you go, and listen at your convenience. And for those of you into social media, we have a presence on Facebook and LinkedIn. Search for Wealthway Financial Advisors. Hit that like or follow button. And once every week or two, we put up an interesting and informative financial planning post to keep you engaged in the process. All right, 627-7979. If you want to jump in on the conversation tonight, we're talking about tax planning versus tax filing. And, a lot of people look to their tax preparer to do the tax planning. And in our professional experience, rarely does the tax preparer, whether that is somebody who works for a national chain or a small independent CPA firm, rarely does the tax preparer do much forward-looking tax planning. And there's a huge level of frustration around that in the local community, of at least among our client bases. So that's why at Wealthway, we have waded into that area of tax planning. And so for our clients, we every year get their tax returns. We analyze and scrutinize the tax returns that have been done, check for any red flags, make sure there was no glaring omissions, and see if they are optimized to be as tax efficient as they can be given their income levels and tax sources, and then income levels and income sources. And then when we overlay our financial planning advice, we can do projections and test out certain scenarios where one of the biggest areas where we can make a long-term impact on lowering clients' tax bill is in Roth conversions, if you are a good candidate for that. And not everyone is. I would say the minority of people are good candidates for a material Roth conversion. Roth contributions to your 401k Roth or Roth IRA, that's a different sort of decision set. That's still great. I'm talking about converting from a traditional IRA to a Roth. Done right, done properly, done at the right time. We have literally saved clients over $1 million of lifetime tax payments due to strategic conversions from a traditional IRA to a Roth. So tax preparers typically don't do tax planning. I will caveat that with saying the larger firms, the more complicated your financial life is, then the better probability you would get some proactive tax planning. If you are a business owner, a mid-sized to large-sized business owner, if you own multiple businesses and you have a complex tax situation and you're in close contact with your CPA, your accountant, your bookkeeper, your tax preparer, then usually throughout the course of the year, they are checking in with you and doing more proactive tax planning. But for the most of us, the rank and file, the W-2 types of employees, very little tax planning comes from the tax preparers, if any at all. So you should look to your financial advisor, if you have one, to do forward-looking tax planning. That's where you're going to find it. You're not going to find it from the tax preparer. What does real tax planning look like? So tax planning involves making intentional decisions throughout the year that influence how income is earned, saved, invested, and withdrawn, and from which accounts is it withdrawn from. And as I mentioned, at Wealthway, we do in-depth tax planning and analysis to ensure blind spots are covered and taxes are optimized for efficiency, right? It's a major part of all household expenses, federal and state income taxes. To ignore that aspect of a person's financial life is suboptimal from an advisory standpoint. So if you're working with a financial advisor and all you're getting is investment management and market talk, you ought to ask about tax planning and how they can help lower your future tax bills. Okay? So some of the key planning areas where this presents itself, what are some of the activities that we do to plan for taxes or try to lower taxes? Retirement account contributions. So that's probably the first, best, and easiest place that most people can go to give themselves a tax break, and that's by contributing to your company retirement plan, whether that's a 401k, 403b, TSP, simple IRA, 457 plan, all the numbers, all the letters, your company-sponsored retirement plan, the first, easiest, best place to go to lower your tax bill, because you make contributions directly from your payroll into these plans. For that money that you contribute to the plans, you are not taxed on at the point you make the contributions. It's that income is deducted from your gross total income, and you don't pay tax on it, and it goes into a long-term retirement savings vehicle that hopefully you get invested the right way. It will get taxed now on the back end when you take the money out of that retirement plan. But in the current tax year, it's the best place to go to get a tax break, best and easiest place to go to get a tax break. Now, then we also look at investment tax efficiency. There are ways to invest more tax efficiently than others. An obvious way is the amount of trading activity that you do in a taxable brokerage account. Taxable brokerage account or an account outside of a tax-protected wrapper, outside of the retirement plans, outside of IRAs, because the trading activity in those accounts is tax-protected while the money is in there. outside of that, if you invest directly with a Vanguard and contribute $100 a month or something to a Vanguard brokerage account or a Vanguard mutual fund, the more you trade in those types of activities, the more taxable activity you generate in those accounts, the more that will be subject to taxation. So are you investing tax efficiently? That's a consideration if you are doing it yourself. Then there's the income timing decisions for people who have some flexibility on how and when they receive their income. So, for example, salespeople on commission sometimes have the ability to flex income and defer this year's income into next year. And if you know that this year is going to be a high income year and you can defer some of that into next year, which is still uncertain, you don't know how many sales you're going to make, then that could be a very tax efficient move to do that. Or if you're a business owner, same sort of concept applies. Can you wait to receive some revenue payments from your customers? Bills that might be due November, December. Maybe you tell them it's okay. You give them another 30-day grace period, and they can pay you in the following year. And so that income doesn't show up in this year. And so, of course, it all depends on where you are tax bracket-wise, what your overall income levels are. And you have to know these numbers in order to even make these decisions in the first place. Then there's the income timing decision. I said that charitable giving strategies, if you are charitably inclined, then we all know that you have the potential to get a tax break for money you give to charities. Right now, it's an itemized deduction, and you would combine it with other itemized deductions. And if all those itemized deductions exceed your standard deduction, then it behooves you to itemize, and then those gifts to charity can be tax deductible. However, I should say that with recent tax law changes, the standard deduction has been increased substantially so that 90% of tax returns, individual tax returns, take the standard deduction. Right now, only about 10% of the population is eligible to itemize, or it's a better deal for them to itemize. And so a lot of people aren't even getting credit for those charitable donations. But if you have serious charitable intent, and there are vehicles that can help in this regard, where you can make maybe a large donation to a charity in 1 year to offset a large gain that you're going to get in the same year, such as a sale of a business, or maybe the sale of a long-held stock or mutual fund or ETF with a large embedded capital gain. Take the gain in this year and offset that gain with a large charitable donation or at least offset some of it. You can marry those two up and be a little bit more tax efficient while being charitably inclined at the same time can be a win-win as well. And then coordinating income sources. So for people who are in retirement, living off their investments, withdrawing from their IRAs at this point, the choice between withdrawing from a traditional IRA, which would be taxed as ordinary income, or from a Roth IRA, which has no tax implications on the withdrawal, you can sort of determine which account, which type of IRA to take your withdrawal from to hopefully keep you in a lower tax bracket from creeping up into a higher one from a traditional IRA, and then having the higher up you go in brackets, the more income is subjected to higher amounts. So be able to have that tax flexibility, that income flexibility by the different IRAs is just one example of how you can coordinate income sources to plan to have a lower tax bill. All right, we're going to pause right here for our last break. 627-7979. If you have a question or comment, I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial
welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zibna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, look us up online at wealthwayadvisors.com. All right, tonight we're talking about the difference between tax filing and tax planning. I was talking about the coordinating income sources on where to take income from when you're in retirement. Well, the converse is sort of true. When you contribute to these different types of IRAs, has different tax implications. So traditional IRAs, contributions you make to those, you get your tax break when you contribute to them on the way in. So the money going into the traditional IRA, you get your tax break. Investment activity stays tax protected while it's in that wrapper, and only when you withdraw money from the traditional IRA is it taxed. But when you do that, then it is taxed at the highest ordinary income tax rates. It gets layered on top of all the other income sources that you have in a given year. Now, Roth IRA and are also a favorite long-term planning tool, health savings accounts, those work differently, almost conversely to a traditional IRA. The contributions you make to a Roth IRA and, first off, just Roth IRA, there's no tax deduction on those contributions. So you don't get your tax break on the way into a Roth IRA. But once the money's in there, investment activity still tax protected. But because you did not get a tax break on the way in, you do get your tax break on the way out. So when the money comes out of a Roth IRA, it is not subject to income tax. So we love the combination of both. And people usually ask, well, which is better to contribute to, a Roth or a traditional? The answer is, it depends. Generally speaking, though, early on, you want to take your tax break when it's most valuable. So you want to get your tax break when you're in the highest income tax brackets that you're going to be over your working life. So generally speaking, for most people, when you're young and starting out in a career, you're making probably the lowest amount of money that you're going to make in your career. So that's a good time to contribute to a Roth because you're in a low tax bracket. You're not foregoing much of a tax break on the way in. So make your contributions in your early years, generally speaking, to a Roth IRA or Roth 401k if your company allows that. And then when you hopefully retire at age 65 or something like that, and you have other income sources, Social Security, you might have a pension, you might have other investments that you can live off. Then you're in a higher tax bracket. Then you would take out the money from the Roth tax free. Mid-career and late career, when you're in your hopefully highest earning years of your work life, then that's probably when you want to shift from a Roth contribution to a traditional IRA contribution or traditional retirement plan contributions and get that tax break in the year that you make it because you're in a higher tax bracket at that point in time. So that's kind of a rough way of thinking about Roth versus a traditional IRA. Okay, so why do people miss tax planning opportunities, right? It's all out there in front of us. Most of our lives, if we're W-2 employees, we're getting a paycheck from a company. We have relatively simple tax lives. We should be able to plan this out in advance and be strategic throughout the course of the year. But here's some main reasons why people don't miss their planning opportunities. Financial decisions happen throughout the year without considering taxes. People just muddle throughout the course of the year, especially do-it-yourself investors. who have taxable brokerage accounts. It's one of the biggest mistakes we see. Failure to track cost basis. I won't go into what that is right now. It's a little bit beyond this conversation, but you got to have your cost basis. That's a date and dollar amount of the investment that when you purchased it. You got to retain that, because when you go and sell it, then you're going to be taxed on the profit, or you're going to be able to deduct the loss. So you got to know that cost basis. You got to pay attention to that. Tax preparation is separated from financial planning conversations. No, so that's another reason why people miss it. So they think of taxes as their own separate entity. No, tax planning is a component of good, comprehensive financial planning advice. If you aren't having tax planning conversations with your advisor, you want to think about that advisory relationship and whether it's in your best interest. Another reason people miss tax planning opportunities: many people assume taxes are too complicated to influence. The tax code, I don't get it. I don't understand it. Look, I'm with you. I struggle with it too when I get into the weeds. But you know what? That there's money to be made if you just maybe structure your affairs in such a way as to be more tax efficient. So the juice is usually worth the squeeze. And then individuals focus on short-term decisions rather than multi-year outcomes. Yeah, this is a big one too. People think, how can I lower my tax bill this year, right? That's what we're all trying to do every year around tax time. But from a planning standpoint, if we step back and take a longer lifetime look at what your taxes are liable to be, and then we make strategic, big tax, potentially big tax saving decisions that could extend for the rest of your life, that's when you really lever up on the tax savings over the course of your lifetime. And I used the example earlier of Roth conversions being one of those potential strategic moves that people can make if they are good candidates for it, that can save them hundreds of thousands of dollars over their lifetime if done properly. So oftentimes, financial decisions are made in isolation. They are not made with thoughts to what the tax impacts will be. People often have a disconnect between investments and taxes. Payroll withholding can hide your real tax picture. You know, what you sign up for withholding with your payroll or HR department generally impacts whether you get a refund or you pay at the end of the year. And proactive coordination between tax professionals and financial planners always improves long-term outcomes. Get those two people talking together. All right. The tax goal isn't to avoid taxes entirely. It's to make thoughtful financial decisions to organize your affairs so that they're highly tax efficient and that you grow your net worth, which is your true measure of wealth, over time. That's all the time we have today. We'll be back in 2 weeks on Tuesday, April 28th. Until then, I'm certified financial planner Kevin Zivna. You've been listening to Dollars and Common Sense on News Talk 790 WNIS.